How to start investing if you have a full-time job. The information in this video is for educational purposes only. It is not intended as financial, investment, or professional advice. Please do your own research or consult a licensed financial professional before making any financial decisions. If you work full-time, feel behind financially, and think investing requires hours of research every week, this video is for you. Because the truth is, busy people actually have an advantage when it comes to investing, if they use the right system. Most full-time workers don't avoid investing because they're lazy. They avoid it because they're overwhelmed. You're juggling work, family, responsibilities, and every time you look at investing, it feels like too many options. Too much risk, too much information, so you postpone it, and months turn into years. According to a 2023 survey by Bankrate, nearly 1 in 4 adults say they don't invest because they don't know how to start. Not because they don't want to, because it feels complicated. Here's the mindset shift that changes everything. You don't need more time, more money, or more knowledge. You need a simple, automated system. Most people think investing means watching the market, picking the right stocks, constantly adjusting. But long-term data shows the opposite. The most successful investors are usually boring, consistent, and inactive. In fact, Fidelity once analyzed millions of accounts and found that the best-performing investors were either inactive or had forgotten they even had an account. Busy people win by default, if they stop trying to be clever. The first step is understanding what kind of investing actually fits a full-time job. There are two paths: short-term speculation and long-term investing. Short-term trading requires time, constant decisions, and emotional control. Long-term investing requires consistency, patience, and a system. Historically, long-term investing works because markets grow over time. For example, the S&P 500, which tracks 500 large U.S. companies, has returned about 10% per year on average before inflation over the last 90-plus years. That doesn't mean every year is positive, but over long periods, the trend has been upward. If you're working full-time, your advantage is time in the market, not timing the market. Next, you need the right account, not the perfect one. Most full-time workers should look at tax-advantaged accounts first, because taxes quietly destroy long-term returns. Examples include employer retirement plans like 401ks and individual retirement accounts, IRAs or equivalents. A 401k is a retirement savings account offered by many employers that lets you invest part of your paycheck before taxes, helping your money grow over time. Many employers also match a portion of what you contribute, which is essentially free money for your retirement. An IRA, or individual retirement account, is a personal retirement account that helps you invest money for the future with tax benefits. The two most common types are a traditional IRA, where you may get a tax break now and pay taxes later, and a Roth IRA, where you pay taxes now but your money can grow and be withdrawn tax-free in retirement. Why this matters? According to Vanguard, tax-efficient investing can add the equivalent of 1 to 2% per year in long-term returns. That difference compounds massively over decades. The key point: you don't need 5 accounts. You need one good account that fits your situation. This is where most people freeze, so let's simplify it. For busy professionals, broad market index funds or ETFs are usually the best foundation. Why? Because they automatically diversify your money, reduce risk compared to individual stocks, and require almost no maintenance. Instead of betting on one company, you own hundreds or thousands of companies at once. According to S&P Dow Jones indices, over 90% of actively managed funds underperform their benchmark over a 15-year period. That means most professionals who try to beat the market don't. Owning the market quietly beats trying to outsmart it. This isn't about excitement, it's about results. This is the most important step, and the one most people skip. Automation turns investing into a background process. Here's why it works. It removes emotion, it removes decision fatigue, and it removes procrastination. This approach is called dollar cost averaging, investing a fixed amount regularly, regardless of market conditions. Multiple studies show that consistency beats timing. According to Vanguard research, investors who try to time the market typically underperform those who stay invested, often by several percentage points per year. Automation turns investing into something that happens whether you feel motivated or not. Busy people don't need discipline. They need systems. Let's quickly cover what not to do. Mistake number 1. Waiting for the right time. No one consistently predicts the market. Not even professionals. Mistake number 2. Following social media hype. What's popular online is usually late, risky, or incomplete. Mistake number 3. Overcomplicating. More choices don't mean better results. Mistake number 4. Doing nothing out of fear. Historically, staying out of the market has been far more damaging than temporary losses. Remember, volatility is normal. Inactivity is expensive. Here's a realistic plan you can follow this week. Open one investing account, choose one broad market investment, and automate monthly contributions, even if it's small. According to Charles Schwab, starting early matters more than starting big. Consistency beats intensity. If you want investing explained clearly, without hype, stress, or constant monitoring, consider subscribing. This channel is about building wealth that fits real life, not pretending we all have unlimited time. Thanks for watching. Think long-term.